All right, welcome to Note Investor Podcast. I'm Dan Deppin, and today I'm joined by Edward Brown from Pacific Private Money. Edward, how's it going?
Excellent. How are you, Dan?
Good, good. So excited to have you on the show. I know you had me on yours
Yeah.
a while back, and it was a lot of fun. But I was really interested in learning more about what you do, because I was kind of surprised to learn you do a real estate investing show. But you not only knew a lot about notes, but even run a fund, which we can get into
Yeah.
in a little bit. But maybe start by just giving us a little bit of background on you and what you do.
So I have a bachelor's degree in accounting and a master's degree in tax. And many years ago, I used to do financial consulting. So I had my insurance license and my investment license, and then eventually got my real estate license. And for years, I did investment counseling, sort of like a financial planner type person, financial consultant. And I eventually kind of got out of that. I didn't like the idea of being responsible for people's financial lives. The market would drop 100 points back then, and people would say, "Oh my gosh, what happened?" And it's like, "Whoa, wait a minute! Don't blame me. The markets go up, the markets go down." So,
Yeah.
back in the early '90s, I guess it was, I got involved in buying notes and doing real estate investments, primarily in the mortgage side of things. And so for years I had, excuse me, I had my own hard money loan business.
Mhm.
And then, what's funny though, I don't really like being CEO. I like sales. And so, I didn't want to manage people and all that. So some years after that, I ended up uh, joining Pacific Private Money. And for them, I raise money. I'm in the investor relations department. So I help raise money for some of their funds. That's the short answer. And then I've had a couple of radio shows for a number of years. One's the business show that you were on, and then I have a nationally syndicated sports and business show.
Oh, very cool. So what's your favorite sport? Like what's the main things you cover?
Well, we do cover, the typical basketball, baseball, and football. We're talking a little bit about the Olympics now.
Mhm.
And interesting, and sometimes it's kind of interesting because we try to not get too political, but every once in a while, certain things will come up, which also affect the financial part. Like, with the Olympics in Paris, the opening ceremony and all this controversial stuff
Yeah.
is affecting the business side of the Olympics. And so we kind of get into that sort of thing.
No, very, very cool. So I'm curious why you pivoted away from hard money. Was it mostly that you didn't want to be the boss and run the operations, or was there something about like
Well,
mortgage notes that you liked more than the hard money?
yeah, I liked I really liked the originating of notes. I was an investor myself, and then Mark Hanf's company, Pacific Private Money, they specialized with the owner-occupied consumer bridge loans. And
Hmm.
I kind of like the idea of the residential housing more than the commercial, even though they do some commercial loans, but their specialty is the owner-occupied consumer bridge loans, because in California, there's only a handful of companies, private companies, that are licensed to do that. You can find hard money lenders in California, like crazy, and they're all busy. But
Hmm.
when it comes to wanting to buy a personal residence, a lot of these guys are not licensed. They don't have the software and the continuing education. I mean, it's expensive to get into that part of the section of the business.
Yeah, I've got a friend in California up in Sonoma County that's been a
Uh,
mortgage broker forever, and I think she's been very scarred by the California Department of Real Estate and
yeah,
all of that.
and all
Yeah.
the Dodd-Frank laws. I mean, the thing is, in order, besides the NMLS license, you have to have software, you have to have continuing education, and you have to have all the legal documents. And it's expensive. It's probably, 80 to $100,000 to get into the space. And so if
Mhm.
you're a typical fix and flip lender, you're busy enough right now. Why would you want to spend an extra 80 to 100,000 to get into a new space? Well, we decided to take that plunge, way back in the old days, so to speak now.
Yeah. I mean, do you find that worthwhile? It's kind of interesting, right? Like, 'cause I know a decent number of people that do hard money lending, and one of the things they like about that is it doesn't have all of the consumer lending
Exactly.
implications and the Dodd-Frank stuff.
Yep.
But I was kind of wondering for myself, like, but yeah, if you bite the bullet and you get licensed to originate these things, is that worth it? Because now there's a smaller pool of people who have
Correct.
gone through that.
And that's why I said there's only about a handful. We're not the only ones, but there's only about a handful in California licensed, and I think we're probably one of the largest that do that. We've done hundreds of millions of dollars, and the nice part is we work with other lenders because we're not going to steal their clients. Like especially like with mortgage brokers, if they're going to bring a deal to us, we'll do the quick bridge loan for less than a year. And then when they have more time or they get their credit score up or whatever reason they couldn't do conventional, eventually that broker will cash us out. And then so they retain the client. So we work really well with banks, mortgage brokers, especially the real estate agents. We get calls all the time for if someone wants to buy a house and something happened and the bank or the mortgage broker, whoever, can't do the funding fast enough. So they'll just use us as a temporary loan to get the deal done. And because there's no prepayment penalty, it's not that expensive if they pay us off fairly quickly. It's just the points up front that get a little bit charged.
So you're doing a bridge loan and then they get new financing, or are you creating? Okay, so you're not like creating a loan and then selling it off to the bank or anything like that.
No, we do some portfolio lending, but we also do a fair amount of packaging loans up. So if we know a loan is going to pay off in a month, we're not going to go through the trouble of packaging them up. But if it's going to be a situation where this one will probably last 6 or 9 months, then we'll probably go ahead and package it up.
Okay, very cool. And then how do your funds work, or how did you get into setting up note funds?
Well, it's actually really interesting. So many years ago, when I was doing financial consulting, I'd be asked to sell various REITs and limited partnerships, et cetera. And it wasn't so exciting because you never really can know who you can really trust, right? And then I won't tell you the long story, but basically when I met Mark in 2010, because of the radio show. We started doing the radio show for literally 3 years and never did any business together. We just did the radio show. But because he was in the hard money loan business and I knew that space really well, we were able to good tag team together. And back then, he started his company in 2008. He was just doing individual deeds of trust. So there'd be an investor, one or two investors, let's say, for a note. The interesting thing, and I experienced this as an investor myself, is there came a point where companies were setting up funds, and the funds were getting first crack and taking all the good loans first, and whatever was left over, right, was going to the individuals. So a couple of times this happened where I don't remember how he got a loan, whether it was a broker or a bank or whoever referred it to him, and it would be a smoking hot loan. And let's say, there was like, I'll just make an example, $1 million house, the borrower is going to put down 600,000, only needed 400,000 to close the deal. And has an 800 FICO score. But the catch is they got to close the deal in 2 weeks. So Mark would tell this, at the time, Mark was just a broker. So he didn't have the money, but he had the clients who had money. So he would tell the borrower, don't worry about it, I'll get your deal done. So he would send out a blast email to, let's say, 40 of his best clients who he thought had the money. And within, let's say, 20 or 30 minutes, maybe 4 or 5 people would call or email back and say, hey, that's a great loan, I'll take it. And it's like, ooh, okay, first guy who said yes, I got to give it to him. And the other 4 people, I've got to say, gee, I'm sorry you're too late. And that actually happened to me. I mean, I remember one time working with some broker in Los Angeles, and it was a great deal. And I literally happened to be on my computer. I got the email, same sort of thing. Here's a great deal. Do you want to fund it? I kid you not, within 17 seconds, I wrote back and I said, yes. This, I mean, obviously I'm not committed yet because I want to see the file, but it's like, yeah.
But you're interested, yeah.
But I'm interested, sign me up, right? And I got an email back like 2 minutes later saying, I'm sorry, you're too late. And it's like, really?
I've had that too.
You have that too, right? So what's happening is, you get that a couple of times from the same broker where I mean, obviously 17 seconds, I didn't spend that much time looking at it, right? But eventually you tell the broker, stop sending me deals. unless you're going to guarantee that you're going to send me something that if I say yes, you'll give me at least, let's say 24 hours or at least a couple of hours to look at it, right?
Hmm.
So Mark was experiencing the same thing, and where he had a couple of clients do the same thing. They would, quote, yell at him saying, stop sending me deals. Well, he realized, this isn't going to be very good because he couldn't take the risk of just giving it to one person and saying, okay, you've got, an hour to decide. Otherwise, I'm going to go to the next person. I mean, it's not
Well, yeah, because then you run out of time. You don't know if
run out
they're
of time.
going to be
Exactly.
online.
That's
Yeah.
right. So Mark knew that I was fairly familiar with funds. So he said, Edward, I'd like to start a fund. And I thought, oh no, what do you want to start a fund for? And when he explained, and I could say, yeah, I could relate to why, because I get the same issue, with other brokers. He said, would you help me start this fund and help me raise money for this fund for this exact reason? I want the fund to raise the money. That way, when a good deal comes, the fund will just take it. And I said, you know what, Mark? I said, only because I've gotten to know you for about 3 years and we hadn't done any business together, but I could tell you're a pretty stand-up guy. So yeah, I'll help you, but only if you let me have some input. And he said, well, what are you thinking? And I said, well, right now, what kind of documents, what are you, like if somebody wants to get out, what do the documents say? And he says, well, we're thinking about a 5-year hold. I said, it's too long. I said, make it 2 years. And he goes, okay. And then literally after a year, he changed it to only a 1-year hold. Okay.
Yeah.
And then I said, okay, how are your interests aligned with the investor and, all that sort of thing. So he thought about a lot of that stuff ahead of time. So I really appreciated his integrity. And we, started off slow. And then that fund grew to about 60 million.
Oh, wow.
Yeah, over a few years. And then what happened was kind of interesting was he had a credit line with a bank. And the reason is because although the fund itself is technically not leveraged, so it's a clean yield, well, what happened is, let's say in that example where a borrower puts up 600, needs 400, what happens if he only has $300,000 in the fund? He wants to be able to fund the whole 400,000. So he would tap the credit line for the extra 100. And then as soon as either new money came in or a loan paid off or et cetera, he'd pay the loan right back. Well, this was working great for, I think about a year or two, I think probably 2 years. And this is back in 2017, 18.
Mhm.
And then one day the bank, said, hey, listen, you've been a great customer and you've never been late or anything like that. But by the end of December of this year, we're just not in the space anymore. So we're closing the line.
Mhm.
So he went to the attorneys and said, hey, can we start a whole separate fund that'll act as like a credit line? And they said, yeah, why not? So he started his other fund called the Freedom Fund, where it was designed to do that, to do short-term loans to the other fund, but also to do loans where they could sell to other institutions, packaging up loans and all that. So it was very, very short term. And that fund grew to about 65 million.
Oh, wow.
Yeah. And
Yeah.
then,
So
yeah.
yeah.
Well, I was going to say, and then what happened was on my own, I was getting involved with discounted notes,
Mhm.
pretty much mostly performing. And I thought, you know what? We don't have a fund that buys discounted notes. It's definitely different because they're existing already and they're discounted. So for about a year, close to a year, I think, I did this on my own. And when I realized, you know what, this might actually be good, I brought it to Mark and we started the Southwest Fund. And that's the fund that I'm one of the managers of. That fund's small. It's only about 10 million right now.
Yeah. Well, that's very cool because I run into a lot of the same things, except
Okay.
on a smaller scale, right? So a lot of times I'll have investors fund individual note deals, and I have
Yeah.
a list.
Yeah.
And so when I get something, I'll send it out to the list, and inevitably, like more people will subscribe
Yeah.
than I have notes. And the way that I've tried to handle that is I just create a short list. So I'm like, okay, whoever
Okay.
responded first gets it, and then the people who missed, when I get the next one, I'll send it just to them
Oh, interesting.
and give them a shot. And then that way, if somebody wants something, like they'll eventually get
Well,
it. So that's
and
the way
here's
I've
the thing
tried to
is,
manage it.
you
Yeah.
don't know at the time that the first set, let's say, let's say set number two, they had the money, but they didn't get it. It depends on how fast you're going to be able to get them a new note, and if they still have the money at the time. Because
So that happens a lot too, right? So a lot of times when I go back to them, it could be a couple months later,
yeah,
and they go, "Oh yeah, I deployed the money in this multifamily
exactly.
deal." Because all these people, right? Like they're wheeler dealers. They've always got stuff
Yeah,
going on. They're not generally just sitting on a bunch of cash
yeah. And
forever.
I'm kind of,
Yeah.
it's interesting because I kind of balance it between, like, as an investor, being in a fund with, obviously, I got to trust who the managers are, right? Because
Hmm.
it's kind of it's a blind pool basically. Versus, there are some people say, I just will not do a fund. I know exactly which loans I'm in, and I totally get that, and I'm kind of like that too. But what ends up happening though is, in many cases, when your borrower pays off, unless you've got another loan to go right into, that money's
Hmm.
sitting around earning, now it's probably earning, 2, 3%, 4%, depending upon what you can get at the bank, until the next good loan comes up. And you don't want to be so liquid and be nervous about not earning a high rate that you go for a lousy loan. So,
Yeah.
right. And so when you look at the rate of return that you can earn in a fund that's diversified and somewhat liquid, right? Because if you do a 3-year loan with a borrower, you're stuck with that until that borrower pays you off. And sometimes they need an extension. So,
Hmm.
so I'm not like 100% one way or 100% the other. There's pros and cons to both.
Yeah, it's an interesting challenge, right? Because eh, I generally maintain a fair amount of cash on hand so that if I do find something to buy, I can do it.
Yeah.
And
Yeah.
like you're saying about like using like creating the fund for the bridge lending is interesting. What I do is I'll often use the home equity line of credit
Yes.
on my home, right? And so I'll just if I have a
Yeah.
deal that way, I can just go out and buy it, do the due diligence, get it, and then worry about the funding a little bit later. And then when I get the funding,
Yeah.
just pay that back right
Exactly.
away. So it's
And
funny how
I've done
everybody
that
has the
too.
same issues. Yeah.
And the best part about that, especially since, I'm surmising that both of us are very disciplined. You're not using your home
Yeah.
equity line to go buy a boat or something, right?
No.
Is that right? Is that you're not paying interest on that if it's not being used. So the only
Right.
time you're dipping into it is, and you're, hopefully you're borrowing at, let's say, 8% from the on your HELOC and investing it at, 10, 12, 14, whatever you're doing. So you're getting a positive arbitrage. And then when new money comes in, best thing to do is like, it's like people who have high interest credit cards, just pay them down. That's the best rate of return, 20%, right? So it's the same thing. I'm exactly the same way. And I think it's
Yeah.
worked
It's
out pretty
funny.
well.
And I've thought too, right? Like I could do that arbitrage. Like I could just max out the HELOC and go and buy loans and
No,
hold them.
no,
But then I would be losing. Well, one, you're taking on a little bit of risk, right? But
exactly.
then two, I'd be losing that flexibility
Correct.
to have the cash around to go out and buy things when opportunities
No, you're
pop
you're doing
up.
it.
Yeah.
You're doing it the right way because, yeah, you don't, for those exact reasons. One, you don't want to get tapped out because then you'll miss out on some other opportunity. I mean, if you're doing it like, okay, I'm going to tap this out, but I know that, within 3 months, other loans are going to pay off, or I'll get out of this situation. I'll raise money and people cash me, whatever. If you got a good plan on that and it's short term, then yes, it's fine to tap it out. But
Hmm.
but you don't want to do any, long term, because you don't want to put your house at risk.
Right.
So no, you get a grade A from me for that, Dan.
Oh, well, thank you. I appreciate it. Yeah, because I don't have the master's in accounting and tax and
Well, I mean, that part
all
of it,
that stuff. I have the MBA, I
economics
guess, but
first,
yeah,
taxes second.
yeah.
It's that way. It's so funny. Sometimes in the old, I mean, there was a time I was doing like 200 tax returns by myself, and it was just too overwhelming. But I'd have clients who, when they look and could find out how much they're going to pay in income taxes, they say, maybe I should go buy, a car, or a boat, or whatever, equipment, not a boat, equipment,
Uh,
etc., or a lot of inventory or something. And I said, well, do you need it? And they say, well, no. And I said, well, no, yeah, but it's a tax write-off. And I'd say, well, let me put it in easier terms. I said, you know what? I'm doing your tax return, and some of it's business. So instead of charging you $1,000 for your tax return, I'll charge you 10,000. What do you mean? Well, but it's tax deductible. And
Yeah.
then finally they realize, oh, wait a minute, I guess that's not smart. So always look at economics first, taxes second.
Yeah, yeah, that's pretty funny.
And on our, it's interesting because now, forgetting the fact that interest rates might drop in September, we're
Mhm.
at a point right now where, depending upon how much people invest in our freedom fund, uh, the investors are getting anywhere from I think as low as 8 and as high as 11. Because we
Mhm.
have some people who have over, 7 figures with us, and for that, basically all we're doing is just cutting our profit. But there's so much demand for our product, that we can't keep up with it, and that's why I'd much rather earn, you know 1 point on $1 billion than earn 3 points on a million, right? So
Right. So,
it's
so you
all about.
have like a tiered payout, like you do a structure where the more somebody invests in the fund, like the
Yeah,
higher return they get. And is
correct.
that like a straight, is that like a flat return they pay, or is it like a return plus, like a preferred
No,
plus
it's
something?
just it's just a flat higher rate that we pay, and what we'll do
Mhm.
is we don't guarantee it for life or anything, but we'll guarantee it for, let's say, 6 months, and then we will review it and see if we can continue. And if we can't, then we'll let the borrower know, or excuse me, the lender know, and then the lender can decide, or the investor at that point, the investor can decide to liquidate, and then we
Mhm.
we we in the quote old days, before Silicon Valley Bank situation and all that.
Oh
uh,
yeah, I remember that was that a year ago or 2 years
yeah,
ago
something like
now.
that. Yeah,
Yeah.
it was a lot more fluid. Like in our Southwest fund, whenever anybody's needed to liquidate, we've been able to liquidate them right away. On
Mhm.
the Freedom Fund, sometimes it takes 30, 60, 90 days, etc. So we just have to tell people that, if you put in your request, you may not get it, in 30 days. It may take a while,
Mhm.
it can get spread out.
And then how do you handle it when you've got these loans that are making payments every month and you're getting these like little bits of cash? Like, what's your strategy for then redeploying that, or is the fund large enough that there's enough coming in every month? It's relatively easy to go out and buy more loans and keep it deployed.
Yeah, well, remember, if we're going to charge the borrower, let's say, 11% plus a couple of points, and let's say our average that our investors, because some are earning higher and some are lower, depending upon how much they're investing. Let's say
Hmm.
the average is 9%. Well, borrower pays us 11. I mean, we keep the points, to keep the lights on and overhead. And then when borrower pays 11, we pay 9 to the investor and we keep 2. So it's just a constant flow of money.
Gotcha.
Yeah.
Gotcha.
And so far, so good. No one's lost any money. We've had loans where we've had to foreclose, but that's
Yeah.
usually been a good thing.
Now, are you buying a lot of loans in California, or are they spread
So
across the
the
country?
our Southwest fund, the one that we buy loans, none of them are in California.
Yeah.
Yeah, most of them are in Texas, and then
Mhm.
we've started to branch out to other states. So we try
But
to, and it's interesting because this fund, I got to think, is going to be one of the more conservative funds because our average loan to value is right around 50%, but because we're buying at discount, it's about 38%. So,
yeah.
there aren't too many funds and it's unlevered, that's paying, and on that fund, we're paying a flat 8.5%.
Yeah, that definitely keeps the risk down, right? Because
Yeah.
especially the loan was originally like there's so much equity, and even though like there's some signs that it's always hard to tell. Like I've given up on like economic predictions, but like even if you
Yeah.
hit like the next recession or something, I have a hard time seeing property values drop significantly enough to cause such a big problem, especially because the underwriting standards have been so high the last
That's
10, 15
there's a
years.
bunch of
Yeah.
reasons. One, since the Great Recession, there's been a huge increase in property values. So a lot of those people have a lot of equity. There's been, and I say no matter what side, without getting political, whatever, no matter what side of the aisle you're on, the fact that we have, roughly 15 million new people, into the United States, they all got to live somewhere, and they're not all going to live in the New York Roosevelt Hotel. It's eventually going to, spread out
Hmm.
amongst other places, and rising tide lifts all boats type of thing. Everybody needs a place to live. My wife and I have discussed this, that if things get really bad, we might have to downsize, but she won't let us live in a tent. So
Yeah, I wouldn't want to do that.
no. And so, again, because everybody needs a place to live, there's going to be demand, right? I mean, not everybody needs a boat or an airplane that they own, but everybody needs a place, right? And our average, most of the loans in our Southwest portfolio are fairly small, 50,
Mhm.
60, $100,000. So the interest rate, or the monthly payment that these borrowers are paying, I think the average is only about $600 a month. So
Yeah.
it's spread out throughout the country and Texas and all that. So if you think about it, if somebody owns a house that's worth 120,000 and they only owe us 45,000 and their monthly payment is $580 a month. Now, forgetting taxes and insurance, right? Where can they live for $580 a month? And why would they be willing to give up $75,000 worth of equity to us to let us foreclose on it, right?
Yeah.
Once in a while it happens because, as someone once said, you can't fix stupid, but
Did you think, yeah, so I'm curious because I had a situation just come up in the last week or so where borrower had a lot of equity, is in foreclosure, and was doing things that just don't make any rational sense. Do you think
yeah,
is it just a lack of financial literacy, or is it that they don't realize that they have this equity, or like what is it that
I
makes a borrower when
um
they,
I think I think part of it's the emotional part about, I've lived in this house for X years. Nobody's going to kick me out of my house. So there's the denial, there's the financial literacy part, there's the emotional attachment. I mean, we had a situation in Texas where the house was worth about I want to say 170,000, and or no. The house was worth about 200, and our loan was like 120,000. Excuse me.
Mhm.
And the guy paid for a while, and then whatever reason couldn't pay. And we told him, we said, look, you've got about $100,000 worth. By the time we were going to start foreclosing, about $100,000 worth of equity, and we're not talking about a $15 million house that has 100,000 equity. We're talking about a house that's 220,000 that has 100,000 equity, right?
Yeah.
And we told him, we said, basically, don't let us foreclose you out. I mean, if you're not going to pay your payments, we're going to have to foreclose, but you'd be better off selling your house. No, nobody's going to kick me out of my house, blah, blah, blah. You'll have to get the sheriff and with guns toting and all this kind of stuff, right? And we kept telling,
Yeah.
look, we're not trying to be mean or anything, but we have a fiduciary obligation to our investors. If you're not going to pay, we're going to have to foreclose you out, right? It's that simple.
I had a similar
Well, let
conversation.
me just finish off the story real fast, right? So what ends up happening is the sheriff comes and kicks him out. He doesn't come out with guns a-blazing. We sold that property for 300,000.
Wow.
It all came to us. I mean, we kept telling him, don't let it come to us. But okay, go ahead. What was your
But yours, so did that sell at the sheriff's auction and then you just got paid what you were owed, or was that like a land contract where you just got the property?
Yeah, we got the property and then just sold it.
Yeah. I have one where I've got a borrower that owes a total of, it's like a little over 50,000,
Yeah.
and hadn't been able to make contact with her for a long time. Finally made contact, and when I was reviewing the file, the property looks to be worth at least 150.
Yeah.
And it looks like she took out over 200 in insurance on it. And I had the conversation. I let her know. I said, "Hey, did you know how much equity you have in this?" And she said, no, she had no idea. Because I told her kind of the same thing. I'm like, you could now in this case, it would be a judicial foreclosure. So I'm like, if it forecloses, it'll sell for probably a lot more than it's owed. Like you'll actually get a check at some point. But I said, if you sold it on your own, it would sell for more.
Yeah.
So at least just kind of sitting on a gold mine.
But also they have to move.
That's the thing. Yeah, that's the rub. Yeah. Which requires like doing something. Yeah. So if you're not going to make that couple $100 payment, are you really going to find a place? Like moving's a pain in the butt.
It is. And where's she going to, and her mortgage payment was what, 200 and something dollars?
Yeah, this one is like I forget offhand, but probably like $400
400
ish, and then
bucks,
some taxes and insurance. But rent's going to be at
1100,
least yeah, or at least 800 in that area,
800.
maybe a
Yeah.
thousand.
What,
So
what state was it?
this is South Carolina.
Oh yeah, yeah. No, we've got definitely got some in South Carolina, and yeah, it's just I don't know. Maybe we should go around the country educating people. I mean, then there's going to be people who are going to try to scam the system, and it gets really frustrating. I've had, I had a, in fact, I literally this I try to kid you not. I get a call on Friday from my uh, uh, mitigation loss department head guy,
Hmm.
and he says because we have we kind of dabble in some not non-performing loans.
Yeah.
So he's on the phone with me, and I said, "Well, I'm kind of in the middle of something." He goes, "Edward, this is an emergency. I've got our New York attorney on the phone because we do some stuff in New York. A lot of people shy away from it because you definitely have to have a sharp pencil."
Yeah, I shy away from it just
Yeah,
because I mean I could do it, but like why spend the time and energy? I just do it in other places.
yeah, that's true. And the thing is, I guess we have enough resources to make it worthwhile. So what had happened? The attorney gets on the phone and he says, "Edward, you you have to get on an airplane on Sunday to be in court on Monday morning." I said, Why can't we do Zoom?" You go, "Nope, this judge does not want Zoom because he effectively wants people to to settle." I go,
Mhm.
"Well, that's actually a pretty smart way to do it, right?" So the situation was the guy hadn't paid his mortgage since 2010.
Mhm.
14 years, right?
This is a first.
Is a first. Yeah.
Wow. I
And
mean, it
I,
happens in seconds a lot because they forget
yeah,
about it. But yeah, that's
that
crazy.
was the first mortgage. Yeah, we haven't done any NPL seconds. So he hadn't paid in 14 years. Obviously the accrued interest was up the wazoo. I've only owned this loan for about a year and we've been kind of working on it. And the guy doesn't live there, but he's renting it out. So
That's
he's
so common.
Yeah,
Yeah.
he's collecting all this rent, right? And I'm thinking this guy's, man, what a real operator. And so we get to the court, and they want to strike some deal. And I'm thinking, what kind of deal do you want to strike? And so actually, we actually struck a deal where he's going to start making mortgage payments. Oh no, no, excuse me. He's making option payments. What's very very interesting in this case. We have an agreement where he's going to allow me to foreclose, and I'm going to put the bid so high of what I'm owed that there's no way that anybody's going to to bid it at the
Hmm.
house steps. So I'll be the owner, and then he's got an option to buy the property back from me, and he's got 13 or 18. No, give him 18 months but he's got to make those option payments now. And sure
Yeah.
enough, August 1st, money got wired in.
Nice.
Yeah.
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 I always love it when I get like some kind of forbearance agreement, trial payment plan together.
Mhm.
And it's always hit or miss, right? Like
Yep.
sometimes they follow through on them, sometimes they don't. I've had borrowers where it took a couple tries to get it right because I really didn't want to foreclose. Like I don't,
Yeah.
it's a pain when you get
It
an
is.
REO. Like I
No.
actually try to avoid it, but yeah, those things are always nice
Yeah. And,
when they
and
work
sometimes,
out.
you buy into one where it's already been modified. Uh, but a lot of it is you really do have to do due diligence. And,
Yeah, there's a loan I'm buying now. It's actually the first loan I'm buying in Colorado. It's about
oh,
20-25 minutes from where I live,
oh, wow.
and it had been making payments, but they had been behind before, so there were some arrearages. And as I'm going through the process of due diligence, so I was like, oh yeah, by the way, we just got the borrower to sign a loan mod, and they're rolling the arrearages into the balance.
Okay.
So I had bid this based off the unpaid balance, but now when I get it, the arrearages are rolled in, and the payments actually higher. So I've actually got
Oh,
like a more valuable loan
oh, wow.
than what I was
Yeah.
bidding. Yeah, and I hadn't closed yet. So if it had gone the other way, like if they had devalued the loan, well, then I had the option to be like, wait a minute, that's not what I signed up for.
Yeah. And,
That was a nice
I don't want
surprise.
to throw anybody out of their house, but they need to be reasonable. I mean, some of these people, they haven't been paying mortgage payments, for, 5, 10, 15 years. And well, can you take, like this one guy we're working on right now, again, another New York one, where he says, well, I know I haven't paid in like, 12 years. Can you take all of that, throw it on the back end? Well, the back end, it's at 35 years to go. I'll be dead by then.
Mhm.
and then he wants his payment and he wants his interest rate to be like 2% and his mortgage pay. I mean, it's just he's ask. And it's like, well, can I ask you a question? When you weren't paying your mortgage payment for the last 12 years, what did you do with that money?
Yeah.
And the guy was complaining. He sent some email where, I mean, and you've been in business long enough too. You see, people try to take advantage of, this guy's complaining because his elderly mother is sick, and he puts in bold, she's elderly, 66 years old. Seriously, I'm not kidding. And I'm going, wait a minute, I'm 64 and a half. I don't feel elderly.
Yeah, she could run for president like in 20 years from now. Like 20 years.
I mean, I understand if he was 96, then okay, I can get.
Yeah, she'd be a candidate for the 2044 election. Like she's
Yeah.
a spring chicken. Yeah.
I know that's why you try to help people. I mean, if things can get modified, and sometimes what happens is people will be okay on the mortgage payment, but then they get behind on an insurance, right?
I've
And
had a lot too. Yeah.
taxes.
Taxes. Yeah.
So sometimes, if someone's had a real hardship, then sometimes we'll just say, okay, well, we'll pay this and just pay us back over the period of a year, and then
Yeah.
usually not even within any interest.
Yeah. My favorite is when they complain to me why their tax bill is so high. And then they also complain to me, some of the counties when taxes are late, like their penalties and interest
Right away.
are really exorbitant in
Yes.
some cases. And then they complain about that and they try to like negotiate it with me. Well, that penalty interest and that thing was big. I'm like, you need to talk to your county. Like I have nothing to do with that. Like,
Come on, Dan. Take
Yeah.
some responsibility for their real estate taxes. So we had this one lady who, she was the typical complaining as to why she couldn't pay her mortgage payment. All right. But this story was kind of a little bit odd. She said her son had died and she was still making payments on his truck. I'm going, wait a minute.
Okay.
First of all, even if it was your truck, are you telling me a truck is worth more than your house? And it's your son's truck. It has nothing to do with you, unless you want the truck,
And she's like, you really love the truck though. It's a great
Yeah,
truck.
I guess you really do love the truck. Yeah. Or people will take pictures of, how poor they are in front of their house, and there's a brand new truck with the brand new license plates on it and stuff. I mean,
Oh, I haven't had that. I have had ones where I've bought non-performing loans,
Yeah.
and I always get photos of the property beforehand. And you see some like really nice SUV parked out front, or some expensive
Exactly.
cars, and
Yeah.
or I've seen boats and things out front. And it's like, okay, they've got money for something. I think they can
Yeah. And
figure this out.
well, it's unfortunate that, maybe 100 years ago or 200 years ago, the laws were such that, oh, you didn't make your mortgage payment, that's it, you're out, I own the house today. Like,
Mhm.
then that's egregious. That's way, way over the top. But the pendulum swung so far the other way that people, even people with normally good intentions, some they'll a sister, a friend, whatever, and say, don't pay them. Just work the laws so that you can just live here for free and not pay anything. That's like, and unfortunately, that's bad for society and in general.
Yeah, people can talk themselves into all sorts of things.
Yes.
But the thing I think they don't realize though is when you start getting into the late fees and interest and all the other stuff that racks up, even if you drag things out
Yeah.
for a long time, if you want to keep the house, you've eventually got to pay more. So there's not really
And
ultimately a lot of upside in doing, unless you have a lender that just like gives up at some point, which I don't know who's going to do that.
well, one of my favorite lines, it's a little bit sharp, but when people start complaining about all this kind of stuff, I said, what, don't make your problem my problem. I said, because the thing is, especially for if it's in one of our funds, we have fiduciary obligations to our investors. We can't just, we don't have the right to just go, you seem like a nice person. Tell you what, how about you don't owe us anything? I mean, like what the president was trying to do with student loans. Let's just forgive.
Yeah.
Yeah, we can't
Yeah.
do that. Yeah. Why is it that people want to make all their problems, somebody else's problem? Hey, it's your problem now. It's like, no, that's why.
Yeah.
That's why I only do secured loans. People sometimes,
Oh, right.
hey, why don't you invest, in this, like, well, even a piece of equipment can be an UCC one. But, like I tell people, I said, I wouldn't give Jeff Bezos an unsecured line of credit or Warren Buffett
Hmm.
because it's unsecured. I go, you never know what can happen. At least with real estate, there's a real house there.
Yeah, people can get squirrely
Yeah.
and talk themselves into all kinds of weird things. I think the key to it for me, I think, is just not to take any of that stuff personally.
Exactly. In fact,
You know.
I get solicited with all kinds of crazy stuff. I just make it really simple. And I even had friends, this similar situation. I just say, you know what? All I do is I won't invest in the stock market per se. I might have just a little bit just for fun, but because
Hmm.
that's unsecured and really, you
Oh
see
yeah.
company, who knows what it is, right? But at least, and I say I only do loans secured by real estate. And, because I'll have people, oh, if you lend me money, I've got this business opportunity, blah, 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 blah. And I said, listen, if you got real estate to put up as collateral, I'll be glad to take a look at it. But that's it.
Yeah, the thing I'm always curious about, there are those, like, I've had borrowers where they'll get way behind, and right when they're about to lose the house, they'll reinstate the loan. And so you have a borrower with like a $400 payment that they refuse to make, and then all of a sudden they cough up like $8,000
Yeah.
for reinstatement. I'm always really curious, like, where that came from. Like, did they commit a crime? Did they borrow it from somebody they're not
Or
going to
or
pay
they
back?
just
Were they
passed
really
away.
rat holing it? I don't
Yeah,
know.
could be.
Yeah.
And so we had a situation where the woman was complaining, husband was in a coma, daughter's got special needs. I mean, again, I'm not trying to be insensitive, but I've been around enough to know that people will just throw everything and anything as an excuse.
Hmm.
And same sort of situation where, like the other one, where this person had over $100,000 of equity. And we told her, we said, I'm not trying to run your life because it's your life, but from a financial decision, why don't you, because and apparently, oh, lost job and can't afford the monthly payment. So I said, well, and she wanted to do all kinds of like crazy things with the loan. And we said, well, you can't really even afford that. Why don't you sell the house? You keep the extra hundred some odd $1,000 of equity and just live in an apartment, a really nice one for like we figured out she could live for 3 years at a
Hmm.
really nice apartment. I said, until you guys get back on your feet, and then you'll buy something else, such and such. And it was getting closer to foreclosure, and magically she came up with $6,000.
It's weird how that happens. Yeah, when
Yeah,
push comes to shove, people are very creative.
and resourceful. Yeah,
And it's funny, and it seems like unless somebody has a drug problem or,
yeah.
a severe mental health issue, they never seem to end up on the street, like
Well, it's so
somehow or
funny.
another.
Mark was telling me the story before he and I ever met, where he had a borrower uh, one day just stopped paying, and then ghosted him. He just couldn't get a hold of this guy, and it got pushed off, and then finally he says, I have to foreclose. I have no choice. And about 2 weeks before the foreclosure, the guy finally calls him, and Mark says, "Where were you? I've been trying to get a hold of you." Whatever. He says, "I've been in prison." He said,
Oh.
"What?" He said, "But it was mistaken identity." He says, the first call I made was my attorney, and for whatever reason, they wouldn't like let me make any other calls. So and apparently
Oh
it was
wow.
a story. The guy really was imprisoned and it was the wrong. He was innocent. And fortunately, he
Wow.
before it got foreclosed on.
I had one once where I could never make contact with the borrower,
Yeah.
and we were getting close to the end of the foreclosure.
Yep.
And then all of a sudden, out of the blue, he calls me. And this is like in the fall. This property's in Indiana. This is like late October, November. And he's like, "Oh yeah, we're moving out. Just didn't work out. Whatever. Blah blah blah." I'm like, "Okay, that's weird." Got into the property and found out that the furnace was busted. And I think what happened was he was writing it out, and the furnace was broke, and it started to get cold, and then he bailed.
Gotcha.
And
Yeah. Yeah.
he wasn't going to fix the furnace. So
Well, we're dealing with someone now where we foreclosed, we own it, and somehow the guy broke in and there's no electricity, so he's got a generator. So we
oh
have to
wow.
eviction on that. And I tell you, I had this one in California where, um, because I tell people, I said one of the downsides also on an individual deed of trust is you may run into a bad situation where even if your loan is good, a borrower doesn't pay, and it may take a really long time. So don't, to get paid. So don't make sure you don't, this is the only money you live on, because if the borrower doesn't pay, I mean, eventually you'll get your money, but it may
Yeah.
take time. So this guy hadn't paid, and I gave him some slack and yada, yada, yada. I was in, he didn't pay for 2 years because he went in and out of bankruptcy 3 times.
Mm-hmm.
And it just dragged it out. Now, eventually I got all my money and I got all my late fees, but I could, because it was owner occupied, I couldn't get default interest.
Bankruptcy is also expensive for the
Yeah.
lender because of all the, the proof of claim and the things you got to file.
Oh, yeah.
I had one recently, and I racked up $2,500 in legal bills like pretty quickly. So it not only drags out the timeline, but you're also forking out money. Now, like to your point, you will eventually
Get,
pay,
well, you're
but
gonna
it
love
could
this
be a
one.
while. Yeah.
Back in the old days when I had my own hard money loan business, are you familiar with Lombard Street in San Francisco?
No.
Okay, so it's like, the top part of it is, it's the crookedest street in the world, but then
Okay.
Lombard is like a major street in San Francisco. And I don't know, hundreds of thousands of cars per whatever day or month or whatever go by. It's the main street. And
Mhm.
and this property was a good piece of property. And our loan was only about 20% loan to value. I mean, it was a smoking hot loan. And back then we were charging 15% and a bunch of points and all that. And this
Mhm.
guy was a real operator. And he was not an attorney, and he was not a real estate agent, but he knew more about real estate and bankruptcy law than anybody, just because he knew how to
Yeah.
work the system. This loan was only $195,000. In a period of 3 years, he had our attorney in court no less than 18 times. The legal
Oh,
fees
wow.
were 150,000, and this was back in the 90s.
Mm-hmm.
And thank goodness the judge allowed us all of it, because otherwise, if he would have only allowed half of it, my attorney would have looked to me and said, "Sorry," you know. Uh,
Yeah.
yeah, so 150,000 of legal fees on a $195,000 loan.
That's
Nice.
crazy. Well,
Yeah.
that's probably a good happy note to end
But
this
you
one.
know what? It's funny because I look back, and even though it was only a 20% loan to value in a great neighborhood, if I knew what I knew, I wouldn't have done it. It
Yeah.
wasn't worth me. I mean, literally, I think I charged this guy 15% and 8 points or whatever back then in the 90s. And it was not owner occupied; it was a commercial building. But
Yeah. I mean, I found if you do enough of these, you run into some really weird outliers. Like if you do one, it's probably not going to happen. But if you do 100, you're going to see some stuff
oh yeah,
along the way.
yeah, yeah. I remember one guy came he just walked in our door, which is kind of odd for a borrower to just walk into a hard money loan. This is my old company, and this guy hands us the spreadsheet and says, I've got 100. He's very cocky about it. I've got $100 million worth of real estate, and I only want to borrow 3 million. And when we looked at it, we thought it was a little fishy to begin with, and then we said, well, just so you know, we always get personal guarantees, just kind of to cover. Oh no, I'm not going to do a personal guarantee. I said, I don't think we're going to give you the loan, because like on a
Yeah.
building that I own, I have a personal guarantee on it. And when they asked me, are you okay about signing a personal guarantee? And I said, of course. I said, I'm not going to let you take my building.
Mm-hmm.
I'm going to pay my mortgage payment. Come, hell or high water, as they say.
Yeah. Oh, and the other thing people will often, I've seen people will say in those situations is, oh, and I got this other person who will lend me money on these amazing terms. It's like,
Then
okay,
do it.
great. That's awesome. Yeah.
Yeah. That's what I tell them. When I've had that sort of situation, and they said, well, I'm thinking about this other loan with, again, these great terms. I said, grab it. I said, get off the phone with me right now and tell that guy you'll take his deal. That's a fantastic deal.
Mm-hmm.
Usually it's smoke, but
Yeah, I know exactly. Yeah, if you
but
call,
every once in a while,
it's always fun. Yeah, checking up on those things and
yeah,
calling those things out. So
yeah,
cool. Well, Edward, thanks so much for joining. I really
yeah. It was
appreciate
a
it. This
pleasure.
was fantastic. Yeah,
Yeah,
a lot
just
of really interesting stories.
yeah, for people interested, in our funds, or even we got some individual trusts that we sell off. Just check us out, Pacific Private Money. I'm Edward Brown. I'm in the Investor Relations Department.
Okay, great. And I'll put the links in the description and everything so
Okay,
people can find those easily. All right, have a
terrific,
good one. All right,
great, thanks. Okay,
bye.
bye.